Hello there, traders. Hello there, traders. Welcome back to TOGS Trading Podcast number 49, which is all about when to go big and should you ever go all in on a trade. Listen, good trading isn't about feeling brave. It's about managing risk with discipline. This episode explores the allure of the all-in trade, why it tempts even experienced traders, and how to build rules so that size becomes a function of edge and process rather than emotion. So stay with us as we delve into that session. Thanks for joining. Thanks for listening. As always, I'm joined by my pal and co-podcast host, Big Ian there in Dublin. Looking good,
Hello.
Billy Ray. How are you doing?
Thank you very much. All right. Okay. As we know, there's been a lot of birthdays this week. My son had his birthday on Sunday. Well, his birthday actually was yesterday, his actual real birthday. But yeah, so we had a children's birthday party on Sunday, and we had another family one yesterday, and so on and so forth. Which is and that was our week.
Nice
Okay.
touch. Well, he's got his birthday at the end of September, which is really, I think we all can agree on, is the very best of times to have your own birthday. I was still celebrating mine last night and stuff after the weekend of birthday celebrations, and then last night I was reliving a bit of my teenage years and stuff in Liverpool. They went to see a concert for Roachford and Level 42. So a bit of Mark King there doing his bit of slapping the bass. So it was all very good. It was all excellent. It was all excellent. But anyway, how's markets and trading been treating you the last week or so since we last spoke, Ian? How's everything been going that way?
It's been kind of average now, to be quite honest with you. Basically because I was overtaken the last 3 days with my son. Well, last 2 days, last two trading days, and having family here and having people here. So what I spent a lot of time, any time I did have, I spent developing setups. And there's a big difference. I just wanted to say, I was thinking about this morning. There's a big difference between developing a setup or improving your setup and a Grail search. This isn't a Grail search. This is just me trying to add something in. So I'm still doing the same central thing. I was just adding in a couple of little things, trying out a few little bits and bobs to see if they would work. I wanted to work on the early morning stuff, because around 8 o'clock you have the London Open. So I wanted to develop the setups that I trade at that time of the day into a more mechanical setup, so that I don't have as much to think about at 8 o'clock in the morning. And that was basically it. That was a lot of what I was doing. And then the rest of it, I mean, it's trading is trading. Unless there's something spectacularly happening during the week itself, which there wasn't, you're going to get more or less the same. You're doing the same thing, you're getting the same results. That's trading for you, I think.
Totally. No, totally. And listen, we did a recent podcast. Which one was that and stuff? It was that like TOGS 47 about building and evolving your system. And as you say, it's not a search for Holy Grail. It is about just basically evolving and developing based upon your increased experience, and also adapting to changing market conditions, or even, as it might be, changing life conditions, etc. So So if you haven't, if you're listening, by all means, make sure you check that out. And before we dig into the next one, thanks to those for subscribing, your comments and feedback. As always, next week's podcast is TOGS 50. I mean, we've made it to 50. And the title of next week's one will be From Small to Large Accounts, the Psychology of Scaling Up. So, for this season, we've tried to build in as many feedback comments from people in terms of what they'd like to see us cover. And we really do appreciate it. That helps us. And a lot of people have been talking about, what can they do to sort of help scale up and basically move from a small account to a larger account. Okay, so that's TOGS 50 next week. So hopefully you'll join us for that. But here we are, TOGS 49, Ian. So when to go big, and should you ever go all in on a trade? What are your thoughts on that?
Well, just one last thing I wanted to say about the improving setups. Because I'm a professional trader, I talk to an awful lot of other professional traders, and you get little things that they're trying out that they find works for them, and that's what leads to an awful lot of sort of cross pollination or evolution of traders. People are working on the same thing as you, and it's one of the reasons why I think you should always be together with other other traders if he possibly can be. When I was thinking about this during the week, I thought that for a lot of traders, sizing up probably the sooner the better. And the reason behind that is that the average trader lasts 90 days. He loses 90% of his money, and then double your position size and save yourself 45 days of pain. That was the first thing that hit me with that. Because an awful lot of
the Riesling again.
Sorry?
Had you been on the Riesling again?
No, actually, I did a rosé. Was the bought a load of rosé recently? Yeah, actually, it's but that was just it was. What was I going to say? And then an awful lot of the profit stuff that you see from spread bettors is nonsense. You know, it's basically what they end up doing is putting. So they say they have about 25% people profitable, but it's over a period of time. So that could be under 3 months. So it could be 25% of people are profitable in round figures over 3 months. And it doesn't say by how profitable. So I know my spread better, they send me an email every few weeks if I haven't used the testing account that I have in one of the spread betters. And then I'll go in, I'll do a minimum sized, just click it. And that trade could be a winner or a loser, it doesn't matter, and then close it down. So that I would also go into those figures. With sizing up, particularly, I think traders' perception of what they have to do, I think is an awful lot influenced by the media. So you get an awful lot of films basically where the antagonist in the film, the person in the film, the hero in the film, has to take a very clear risk. They do all the preparation they have to do for this. Some montage. They have to overcome one obstacle that's against them, and they go and they take the risk, and then they win and they get the money and save the world and get the girl. And that's, I think some people seem to take that as financial advice when they go into trading, and that's not the way it is, basically, because heroes get killed. You don't hear about the people who don't actually make it. So when it comes to sizing up is a very first world problem, I think, in trading, because sizing up becomes at the end of a lot of hard work, because you're sizing up at a time. You should be consistent. You should have your setups down. You should be, a good trader, and then you can incrementally size up. The whole idea of going all in, to me, sort of infers that one trade is that important, and they're not that important. It's just one trade, and so you're not missing. I mean, there's so few things that come along in trading that are so good that not entering them, like Bitcoin, for instance, was for some people was a life-changing trade if they got in at the right time. But that wasn't. But nobody knows that when they're going in. They might think it, but they don't know it. So you only know that it's a life-changing trade when the trade is closed, I think. And, when you hear about these great traders who went all in, there's that great story about Dan Zanger who like sold his boat, mortgaged his house, and then went all into Google, and basically like made a huge sum of money from entering Google when Google was going public. And that's great. He was already a great trader. He had already won. He'd already made millions of dollars, and he'd already honed his skill and all that sort of stuff. This was a man who knew what he was doing, who has the ability to recover, because if he lost his money, he still has the ability to recover. He's not dead in the water. And I think that's and that's a completely different position to be in when you're going all in than to be a newer trader who thinks that he should buy some stock so that he's going to try and make a killing on it or whatever it is. That's a totally different thing. Also, when those great traders go into, a lot of the time when they do stuff like that, it doesn't mean that they're risking 100% of their money. They might have 100% of their money in it. But if you're in a relatively liquid stock, you're still able to get out of it. And I think that's what happened. So if it's liquid, they might put in this, they're going to have a stop loss. So they might have 100% of their money in the trade, but they only have maybe 20% of that as actual real risk. I mean, there's always the possibility they could lose everything, but in reality, that doesn't happen that often. Nothing happens with that aggression very often in the stock market, unless it's some tiny little drug company or somebody did fraud or something along those lines. But that's thankfully, relatively rare. So they're only really risking a smaller amount of money. And again, if you're a great trader, you have the ability to recover from that. So yeah, that was my opening thoughts about it anyway when I was sitting down.
Yeah, your own thoughts. I think there's kind of I suppose maybe just to help us clarify for the viewers and listeners, because next week's is about the psychology of scaling up. And that in itself is a fantastic conversation and such. Here, I suppose maybe let's kind of use the kind of, I don't know, the sort of the right language in terms of going big or going all in. You are right that all traders, all right, okay, nobody's ever immune to getting that sense of they should go big or maybe they should go all in on that trade. You have a bit of a winning streak and you start to be a little bit overconfident in one particular idea. All right, you start confusing conviction with certainty, as you said yourself. All right, it's always easy in hindsight to say, well, if you'd have bought Bitcoin at this price, or if you'd have bought Nvidia at that price, etc., or or you had bought gold at that price, you would of course made life-changing sums, and that's always easy in hindsight, but you don't know at the time, and it is, as I said, it is easy to confuse conviction with certainty. And another element that I think figures into that kind of temptation to go big is about ego. It's about excitement. It's about using size to feel alive rather than to express edge, and that's a very interesting topic of its own to recognize. If you're having to size up to feel alive, that in itself is giving you some real feedback about what's going on within you, all right, and actually something that you probably need to address. And sometimes it's not just ego excitement; it's because the trader has an inconsistent process. All right, they're making big bets outside, okay, of their normal method, because they have an inconsistent process, or there's not real guardrails or the accountability to it, and so they feel that they can make those big bets, and invariably they resent badly. And I think what often underpins all of that is, you mentioned it yourself, survivorship bias. All right, survivorship bias. The media love pumping out stories of the big winners. So in trading terms, you're looking at Dan Zanger there, or you read Market Wizards, or you just read other media tales about guys and girls who've just absolutely hit a home run and have made life-changing sums. Okay, and and everybody gets excited by that, and they see these people and think, well, if they can do it, so can I, which just feeds into that ego and excitement. But it's real survivorship bias that you only hear about the winner. All right, the other 999 guys and girls who just absolutely did their arse and blew up on that event, you never hear about them, because nobody wants to hear about them. We have a proclivity, or a bias towards wanting to hear about winners, wanting that survivorship bias, and then that goes back deeper into our heuristics and stuff, and as to who we were as cavemen and cavewomen, etc. But survivorship bias basically is prevalent all around us. We hear the tales of the guys and girls who've made it big, but not the others who have basically blew up, and so it fools us into a false sense of certainty, a false sense of confidence that we can go big. That actually this is going to be the one. All right, this is going to be the one life-changing trade that basically is going to make you as a trader. But that rarely works out, does it?
No, it doesn't. I think, as I was just saying, I put it a slightly different way where I'd say that a lot of people have a self-image where they want to be the sort of hero character in their own thing, in their own
Hmm.
life, and that causes them to want to take those risks early on. I think a lot of underfunded traders think that they have to trade in a way that's outside of what their account should be trading, because they feel that that's the only way that they're ever going to make money. And what they're trying to do is swap money for time, which is the wrong way around a lot of the time. Most
Yeah,
people swap time for money.
yeah,
Um, and that just doesn't. That just means they blow up sooner. That's all that happens with them. Because people have this, they get into trading and then they start thinking, well, I'll only make 40% a year, we'll say, which is a really good return for like your average everyday swing trader. And ahead of most of the funds, nearly I'd say probably all the funds nearly at this stage. And and they're like, well, I've only got 6,000 or 5,000 or whatever. I can only make 2,000 a year. How long is it going to be before I get rich? And then
yeah.
consequently, then they'll whack on an oversized trade onto something
Oh, yeah.
that's I think people in general are bad at assessing risk. That there's and I think if we weren't bad, and I think men are especially bad at assessing risk, because I don't think if we weren't bad at assessing risk, you wouldn't have fellas gone off on voyages of discovery someplace, so I think just in general as a species, we're not great at seeing risk sometimes. Um, I think there's pressure from other people as well, like because especially with that Bitcoin thing when it was out and about in its heyday, like that there was just if you're not in Bitcoin, there's something stupid about you, and so there was a lot of people who were sort of pressurized into going into Bitcoin just to alleviate some sort of social pressure, that they were the one that was being left out. It's the same thing that causes housing bubbles and things like that. Same idea, I think. Um, I was also reading about Jesse Livermore during the week, and he's thought to be the greatest trader that ever lived, but yet he went bankrupt several times.
Yeah,
Had a really messy personal life, and then shot
yeah,
himself in the head and left a
exactly. Yeah,
suicide note saying that he was a failure. So
yes.
it says something about
He
some.
went all in, he went big and went all in a way there that not the way
No,
you would not the way you'd think. And
yeah,
as a little aside on this, there's a book called, well, there of course everyone reads Reminiscences, all
yeah,
right, and
yeah,
that's
yeah.
good. But there's another one called The Boy Plunger, which is about just Livermore's life story, and it is worth a read. Because actually, the thing it did gave me insight is actually, um, I disagree with pretty much the vast majority of the trading fraternity, who all, as you said, all think he's the greatest trader ever. I don't believe he is, because what's the point of being able to make it big if you can't keep it? If
Mm,
you can't
mm,
keep it, what is the point and stuff? And he would make huge sums, and then regularly, he went bankrupt a few times.
mm,
As you say, he basically, his personal life was all over the place, and he ended up like blowing his brains out and stuff. And
yeah.
also, people don't talking about survivorship bias and stuff. An element of people, when he moved from working in the bucket shops to basically operating as what would they call them, the locals, or on the actual exchange, having a
Mm,
buying a seat exchange. He made no money for 5 years. His account went sideways, but of course nobody talks about that.
mm,
Nobody wants to sort of touch upon that inconvenient truth that actually even the so-called greatest trader you've ever met, had 5 years of, as he changed, he basically went sideways and didn't achieve anything. So yeah, a bit of a segue, but I don't believe him to be the greatest trader, because everybody just, well, it's a perfect example of survivorship bias. Everybody just looks
mm,
at one side of the ledger, as in he grew his trading account, but they kind of don't want to look at the fact that he kept blowing up. He was bankrupt a couple of times. His personal life was a shocker, and then he blew his brains out and stuff. And to me, that's not success.
no.
And maybe, do you know what? Maybe there's a podcast there about definitions of success
Mm,
for traders. I think there is and stuff, but I wouldn't define that as a successful life that he led. And as you said, his note was that he thought of himself as a failure. But so yeah, so Yeah, people might be tempted to go big. They might be able to go all in. I suppose that leads us into that going all in on a trade, but it rarely it rarely ends well. It usually ends badly. And on the one or two people who it does end well with, well, then of course you hear nothing, nothing but the end of it. And I try to get across to people two very simple rules, that just start, well, they feed into this and they feed into just general being a professional risk manager. Namely, rule one is that you live to fight another day. All right? I bring that from my battle management days. Wherever possible, you live to fight another day. And in trading, that means that your whole career should never come down to a single trade or a single day. You should live to fight another day. And the easiest way to do that is to use a stop loss and have position sizing so that, even if you screw up, even if you mistakes, even if you have a bit of a revenge trading spiral, you go from trading 2 trades to 10, you live to fight another day, all right? And you dust yourself off and you come back at it. And the second rule is that you never ever enter a trade without knowing what your exit plan is. Where do I get out when I'm wrong? Where do I get out when I'm right? Okay, you never ever enter a trade without an exit plan. All right. Lots of people love to talk about setups and entries, etc., but actually, professionals are always focused on the exits. Where is my exit? And the same way, James Bond never walks into a room without knowing where his exit plan is. A trader should never engage in a financial market without knowing what their exit plan is. So. Yeah. So have you ever gone all in there, Ian? Have you ever been tempted?
At the beginning, when I started off first, actually, and I started putting on trades, I went in way too high. Not completely all in because I'd actually quite a large account when I started off trading first. So I went into stuff and I lost tremendous amounts of money in some stuff. Like whatever, like 16-70% of my account in an afternoon, I remember at one stage. And it was just trying to trade too big and not really understanding exactly what I was doing. And then what happened as well with me is that I went into a share, the very first share that I ever owned, exploded in price. And I remember thinking this is relatively easy. Like, and I didn't know anything about trading. I just was talking to somebody and they were buying shares and I opened an account and put in £10,000 that I had at the time because it's that long ago, it was still in pounds. And the bloody thing doubled in no time, and I made like £10,000, and I was delighted with myself. And I think then that sort of infected me slightly when I went forward. A few years later, when I started off, and I thought, well, I went in and bought these drug companies, and I was trying to as well. I don't think I was trading necessarily for excitement, but I was trading because I was looking for these big movers, like that sort of 10 baggers and all this kind of stuff, like. And then I was looking in all the wrong places. I was looking in drug companies and waiting for FDA approval, and then trying to jump on this skyrocketing share with shall we say mixed results. I didn't lose a huge amount of money doing it actually because some of them worked really really well, but then some of them went the other way because what goes up very quickly tends to come back very quickly, and then it can go up very quickly, come back, hurt you, get you out of it, and then recover itself, which is relatively common thing to do. The other person I was reading about actually when I was researching this was Isaac Newton. Another guy. He was in the South Seas Company. The stock price of it went bananas.
A load of money.
He doubled his money. He made £7,000, which was tremendous amount of money at that particular time. And then he got the hunger again, and he went all in on the South Seas Company. And he lost £20,000, which was the equivalent of about £4 million now, give or take, which is quite a lot of money. And he refused he stopped people ever mentioning the South Seas Company for the rest of his life in his presence. And I think
that's just a great example of that. Even like one of the greatest brains who ever lived is not impervious to the human emotions, to that feeling or need to go, that temptation to go big, to go all in. Nobody's impervious to it. Nobody's above that. Hence why you have to watch against it every single day. But sorry, carry on, please.
And I think one of the reasons why he got caught is the reason that some people get caught, and particularly with things like drug companies and stuff like that. These small penny stocks that a lot of people tend to trade. Is liquidity, because I can't imagine that the same liquidity. They certainly didn't have basically as efficient market as we have now, and that I can press a button here on my screen, which is right beside me, and exit myself off any position that I'm in for a small amount of money. There are very few fees involved, and it's really, really quick. It's 250 or whatever it is, or something, or 230 per contract, 250 per contract, and off they go. So, and I think that's something that when you are going to actually size up, you have to think about, is whatever you want to size up in, is the liquidity there for you to actually do it? Because you might have a fantastic working setup. Like, I mean, it's in whatever it is. We say oil, for instance, in CL, but CL is not quite as liquid as ES, for example. So you are going to get slippage. So you have to be a little bit aware of the liquidity. And also, I think the biggest problem with sizing up, which always happens to me, is that every time you size up and you change, your psychology takes a kick in the face, because it's a simple thing. We say you double your account, you double your position size theoretically, and you go into a trade, you hit what was your max loss very quickly, generally. So your brain, which you've trained to exit at this particular price, start screaming at you to exit, and then it's the other way around. You're suddenly in profit, your normal profit, what you expect to make on most trades, and your brain is screaming at you to get out, and it causes fear. You're more afraid, you're more anxious, you lose your connection with the market. Once you lose your connection with the market, I think you're in for problems. Because I think the connecting, that sort of like being involved with the market and sort of understanding what's happening in front of you on the screen is super important. And once you change your position size, you're changing your relationship with the market, and you're putting stress on yourself. And it takes a bit of time every time you do that change to readjust. And one of the things that I notice, which is strangely common with professional traders with years of experience, is they get to a certain position size and they just stay there.
Yeah.
So and I've seen loads of traders do that. That they, they're in the market for 15 years. They're professional traders. They know exactly what they're doing, but they just don't grow. For whatever reason, and I can understand exactly why, because an awful lot of traders, they get to sort of the mid, because most of the traders I know now, frankly, are middle-aged, because I'm a middle-aged man myself. So these are the lads I started off with years ago, and they get to middle age and you just don't need it as much. You're not trying to be that sort of same person you're trying to be when you're 25, like, and so they don't need the pressure. They're making a good income, they're making a super income.
Once you're an old dinosaur, the kind of the shock of a huge big loss might have more of a detrimental impact on your overall physical, mental, and emotional health. And you have to manage against that and stuff, or rather than having the let's say the joy of youth on your side to be able to weather a huge big loss. But anyway, the truth of the matter is, you shouldn't, whatever age, you shouldn't be going all in. All right, no. By all means, going big and scaling up. In my words, in my view, my definition of two very different things. Going big is a basically impulsive, ego and excitement sort of driven way, whereby you just get it in your head that for whatever reasons they're never good, that you are just going to go big on this particular trade or this particular day, etc. And it rarely ends well, which is different from a process of scaling up your account. That is a very different experience, and that's what we'll focus more on, I think, next week's one, in terms of TOGS 50 from a small account, or growing from a small account to a large account, the actual psychology of scaling up. But going big is different, and I think what I want to get across to people is that temptation is always there. it is always there. As we said, Jesse Livermore, Isaac Newton, etc. Others, all right, have fallen into that temptation, right? It doesn't. So if you find yourself, you have done it or you attempt to do it, doesn't mean you're a failure or you're an idiot or you're unique. It is a standard human experience. But looking into, taking some time to reflect upon that, to say, well, okay, where is that coming from? Why is that? An awful lot of it is normally external factors, as you touched upon earlier. Is it external factors, as in you want to be able to crow a bit to your mates, or your mates have been asking you how it's going and you're just not making enough money. You want to get out of that job or that kind of life or relationship or whatever. Okay. And there's kind of all these external drivers that are just tempting you to basically to go big, to go all in, to basically, try and go all in and stuff on it. And as I said, it just rarely ends well. And if it does end well, in many ways, that's normally the worst thing that can actually happen to you. A little bit like your experience, Ian, is that, if you win big and, if you go big and you win big, all that does is that sort of recreates neural pathways in your brain that, you don't need rules, you don't need a process. When you feel it, you can just basically lump on a position. It'll be fine and stuff. And in many ways, in that moment of the success of your, go big, win big, you are also planting the seeds of your of eventual downfall. That's what I would suggest. Would you agree with that, or are you on the other side?
I would. And the other thing I think about it is that what people don't tend to do is that they don't value, like, sizing up. Inappropriate sizing up is not valuing skill, because one of the things that people don't know when they go into this business is that money is available. The world is awash with money. There is much more money than there are successful traders. The fact that the fact that money isn't invested with traders is basically because there aren't enough traders who could take on sizable amounts of money. So if you have the skill, I mean, back when I started off first, before you had all the prop houses in the way that you have prop houses now, that you can sign up and do a test and all that kind of stuff, money would come looking for you. There were people whose job it was to find successful retail traders who were making a profit, who could take on cash. So, money is available if you have the skills. And that's the thing, is that if you start off with a small little account, it's if you start off with a small little account and you develop fantastic skills and you are consistent, you have now got a record that you can, well, one thing, you can go to a prop house and pay and try and take a test. Or the second thing is that you can go out and try and find an investor. It's all available to you if you have that skill. If you inappropriately size up thinking that that's the only way that you're going to make money, then you're just going to go burst. I wrote down as well the perfect position size, in my opinion, is a position size that is big enough that you care about it, but small enough it doesn't affect your psychology. Yeah. So you have to be in a way, when you're every trade that you're doing, you have to know its importance. It still is important to you, but it's not so important that it's scary, and that you are and that it's not too small that you just don't care. And that happens occasionally if you trade too small. Trading is often compared to poker. There's another thing I wrote down, you can't bluff the market with your position size.
Right, exactly.
Yeah. Trading, sizing up is a maths question. At the end of the day, that's all it is. It's a maths question. I know I have roughly what this return is going to be. And that's and I know roughly what my account is, and I know roughly where my exit should be, my stop loss should be, and that's all it is. It's just a maths question.
You're right, and I think whilst to sort of almost like set us up for next week's one is I definitely want to reinforce that, as I said, going big is about impulsive chasing the money, whereas actually scaling up is an important part of your trading journey, and it needs to be as a process, and it needs to be developed. Okay, and you're absolutely right. It needs to be finding a level where it's not big enough that it scares you, all right, but it is big enough that you care, all right, and that you are engaged in that, okay, and there are elements of that we'll talk about next particular week. I will admit that I've often talked about having I do have like a HOS account, a hero or zero account, which is an account where I can test ideas and I can push ideas, but it's a small real money account, okay, right, that basically allows me to test my ideas, to push thoughts, ideas, to challenge myself at times. But it's on a different account on a different computer that there are all sorts of boundaries in place so that basically, let's say my main accounts, okay, my growth accounts, my income accounts, my kind of long term, my short term, my intraday, etc. They are all very separate and very different in terms of the way they operate. So I don't think there's anything wrong in having a HOS account, as long as you know that's what it is, and that you use it as a place to test ideas, and to test yourself. But it's not the sort of thing you should be doing on your main account, and that's quite often what happens. That's quite often what does for people is they just have one account that they test in, they challenge themselves in, they trade in, they invest in, and then they wonder why they have absolutely no clue whether they've got any particular edge whatsoever because the data is just shockingly inconsistent. Listen, I appreciate we should probably start to look at wrapping up because once again we can talk about this all afternoon, can't we, and stuff. So what would kind of what would your takeaways be, Ian? What would you think would be good points for people to sort of pick up on and take away from this conversation?
Don't suffer from gambler's paradox. Just because you had a win in one thing doesn't mean that you're, like every time you win, you feel that you should put on more money on the next one. That's just as simple. You didn't have enough money on. It's gambler's paradox.
Yeah.
All you have different setups that you trade, and not every setup is the same. I have setups that are better than other setups.
Yeah.
They perform better, and those are the ones that if I am going to size up or put on more money on, they're also the ones that I'm going to put on more money on first. And that's pretty much it. I mean, it's just to say it again. It's a maths question. I also think as well that if you are good at trading, if you are yourself, and that was the thing that was the first thing that came to me when you suggested this was. It's one of those things. If you're good at trading, you know yourself when it is time to size up. You'll start to get bored. You'll start to be a little bit edgy. You're not being quite as careful with your trades as you should be, and that's often just a signal to, increase your position size by maybe 20%, whatever number suits you. And then just be aware that once you do that, there is going to be some turbulence along the way. Like there's always going to be every time you change position size because your psychology will change as you get used to this new paradigm. There is going to probably be some turbulence, and generally one trade is not that important. So why would you don't make it so important by putting all your eggs in the one basket?
Totally. That is that's actually a pretty good point to land on, the fact that your trading career should never ever come down to one trade or one day. It really shouldn't. All right, if it has, or if it is, or if you're tempted that it is, that basically you need to have a word with yourself. Then you need to have some almost kind of like line in the sand, some sort of kind of circuit breaker that basically stops you from going down that particular path, all right, before you cause yourself any particular damage, etc. So, just as a final point, what I've been doing is, for those of you who've been watching, following, is that I try and create some kind of material, some follow-up materials, just like a PDF from some of the points we talk about here in our session. And what I'm going to also try and do is put in a almost like a worksheet. So if you're listening to this, if you're enjoying this, then if you go to either like websites or I've got like an open school page. But actually, what you can do, you can also listen to this and follow this, but also you can download a worksheet, sort of just covering the good points. So I think hopefully that that's just the coach in me sort of wanting people to be able to sort of take away some of these good points that we make and actually, embed them and utilize them in your own trading journey. Cool, Ian. All right. Yeah. So, listen, going all in is nearly always a kind of story we tell ourselves. All right, it's not a strategy. It's certainly not a strategy for success. Listen, focus on building your edge, respect your risk, and let size grow with a proven process rather than with impulses. Okay. And that is what we're going to lead us into next week's session, which is TOGS 50, about growing from small to large accounts. Okay, the psychology of scaling up and looking at the best ways to do that. So, as always, thanks everybody for joining us for the session. Thanks everybody for your comments and your likes and feedbacks. We always do appreciate it. Please keep them coming, and we'll look forward to speaking to you soon on the next TOGS Trading Podcast. Trade well, everybody. Cheers.
Bye.